Alright, here we are in Business 353. We're working on the in-class problems for Chapter 8, chapter that deals with inventory. So, as we see here, I've filled in the 4 problems for exercises that we're going to take a look at. 8-4, 6, 12, and 18. And the first one, E8-4, includes a question of whether or not a particular, a list of 27 different items, which of them is inventory and which of them are not inventory. So let me just pop that in here. Okay, here they are. Here's the list. And the question that we're asked to answer is the following is a list of items that may or may not be reported as inventory in KiesoVolume1Ch8SelectedIn Corp's December 31st balance sheet. There's a list of 27 items, and our question at the bottom here says, assuming that ASPE is followed, indicate which of these items would typically be reported as inventory in the financial statements. If an item should not be reported as inventory, indicate how it should be reported in the financial statements. And then part B, how would your response to A change under IFRS? Alright, so the first one, goods out on consignment at another company's store. Should that be included in inventory or not? Well, if it's out on consignment at another company's store, it's still our inventory, and it might be separated in a different inventory account, but number 1 should be included in inventory. Goods sold on an installment basis. If the goods are sold, it should be treated as cost of goods sold. The installment basis refers to the fact that that it's being paid for over time, as long as the collectability issue is not a problem. We would record it as cost of goods sold. Number 3, goods purchased FOB shipping point that are in transit at the end of the year. FOB shipping point means that as soon as they are shipped, they change ownership, and since we are representing the owner KiesoVolume1Ch8SelectedIn Corp here, we purchased them FOB shipping point, and so if they've been purchased FOB shipping point, they are our inventory. On the other hand, number 4, goods purchased FOB destination that are in transit at December 31st are not inventory. Number 5, goods sold to another company with SUKAS having signed an agreement to repurchase the goods at a set price that covers all costs related to the inventory. So this one says that we've sold them to the other company, but we've actually agreed to repurchase them. And if that's the case, then we haven't really sold them. So they are still our inventory until we've performed that last obligation. Number 6, goods sold where large returns are predictable. Those actually are not considered part of our inventory to the extent that we have set up an allowance of some sort for the returns. In ASPE, we probably would set up an allowance for returns, whereas in IFRS we would record unearned revenue for those portions. We'd set up a refund liability, and we would record it as the amount of the return would still be treated as unsold inventory, but the amount of the goods sold would be treated as cost of goods sold. Number 7, goods sold FOB shipping point that are in transit at December 31st. Well, if they've been sold, they're no longer our inventory, as long as they're gone from our shipping point, right? So if they are in transit at December 31st FOB shipping point, they're no longer our inventory, they're cost of goods sold. Number 8, freight charges on goods purchased. Yep, that's inventory. Freight charges on goods sold. Nope, that's not inventory. that is somebody else's inventory, that we are shipping them, so it's a selling expense as opposed to an inventory cost item. Number 10, factory labor costs incurred on goods that are still unsold. So number 10, that would still be part of the inventory, right? So that's just business 355, that's direct materials, or direct labor rather, included in the manufacturing of inventory. Number 11, interest costs incurred for inventories that are routinely manufactured in large quantities. That's one of the specific items that may or may not be capitalized, depending on the choice. So you have to disclose the accounting choice, but you may capitalize them as inventory, or maybe not. So option, there we go. We're going to put 11 in the middle because it depends on the choice, the election of the company. Number 12, costs incurred to advertise goods held for resale. Costs incurred to advertise would be advertising expense. It would not be part of inventory costs. Number 13, materials on hand and not yet placed into production by a manufacturing firm. That would be raw materials inventory, and that would be included in our inventory on the balance sheet. Number 14, office supplies. Office supplies would be included not as inventory for resale, but they would be treated as office supplies. So we're going to say it's not inventory. It's not inventory, and it wouldn't be classified as inventory. It would be classified as supplies inventory, which has a different purpose, and so it wouldn't be recorded as inventory for sale. Number 15, raw materials on which a manufacturing firm has started production but which are not completely processed. That would be work in process, and it would definitely be part of inventory. 16, factory supplies. 16, factory supplies would be part of, again, raw materials, so they would be included in inventory. Goods held on consignment from another company. If they're from another company, they're not our goods, so it wouldn't be reported on the financial statements because we don't own them. Goods held on consignment by another company. That didn't we already have that one? No, that's good. That one, the first one, very first one, goods held on consignment at another company's store. This one is goods held on consignment by another company, presumably our goods. So 18 would be included in inventory. Number 19, costs identified with units completed by a manufacturing firm but not yet sold. That would be finished goods inventory, and certainly included in inventory. Number 20, goods sold FOB destination that are in transit. That is our inventory until it lands on the other end. It's in transit at December 31st, so it is still our inventory. Number 21, temporary investments in shares and bonds that will be resold in the near future. Well, temporary investments are not considered part of inventory. They would be treated as marketable securities. They'd be included as cash and cash equivalents in some cases, but they definitely are not inventory. So where are we? 21 over here. 21. Costs of uncleared land to be developed by a property development company. Well, in that case, that's very much like inventory, like raw materials for a manufacturing firm, but it's raw materials for a land development company. So yes, it would be part of their inventory of undeveloped land. Number 23, cost of normal spoilage or waste. Cost of normal waste or spoilage of raw materials during production. If it's the normal amount of waste or spoilage, it would definitely be included in the material cost of the product, and so therefore the part of cost of goods sold when it's sold, but until it's sold it would be added to the cost of inventory as an inventoriable cost. Number 24, cost of waste and spoilage experienced above normal levels. So abnormal levels of wasted raw materials. That would be a little trickier because it's above the normal levels, and so it would be treated as a period cost. It would be essentially poor management, and so it would be an expense of poor management. It would be treated as an expense other than part of the cost of materials. The logic there is that it's not part of the normal purchase of raw materials for the purposes of production, which are just spoiled in the purpose in production. So example here maybe would be water damage. So if you have fabric that you're using to purchase or to produce your product, and you have to cut holes in the fabric, and there's leftover little pieces, that would be waste and spoilage. And you would need to do that because you can't buy small pieces of material that already are formed to your purposes. Whereas if say water damage, the roof breaks and the fabric is damaged, that would be a different kind of expense. That would be an expense unrelated to the production of your materials, and so if you put that into your cost of goods sold and into your cost of the inventory, it would overstate the cost that you expend for your inventory and understate your gross profitability. Alright, so number 25. Number 25, cost to store excess materials inventory for a manufacturer. Storage costs of completed excess inventory, not your normal level of inventory, would also, did I put number 24 in the wrong place? I think I did. 24 over here. Oops. I think we said it was not inventory, but it was the cost of waste and spoilage above the normal level, so it's not inventory. 25 is also not inventory because it's storage for inventory above the normal levels, and as such it's an excess of the normal process. Number 26, costs to store wine as it ages for a wine producer. Clearly storage costs would be part of the cost of inventory, because one of the things you need to have to make good wine is time. And so if it's going to take you time to make your wine out of your grape juice or whatever other basis for your wine might be, the cost to store it definitely would be part of the cost of the inventory, as would the interest costs. If you borrowed money to buy your grapes and whatever, casks for storage and all those sorts of things, the fact that it takes a very long time to produce wine, that's kind of one of the classic examples of a long-term production process, and the costs like interest for a long-term production process would definitely be part of the cost of the inventory. Another example is Georgia pines. In Georgia they have pine forests which are grown. And Georgia has a very good climate for growing pine trees. They grow very straight and very tall. There's lots of water on a regular basis. There's lots of heat units to make them grow straight and tall. And so Georgia pine takes a while to grow, but the interest to finance the land purchase and all of those sorts of things would be part of the inventory of production. Now that could be viewed as an agricultural process, and so it would have some slightly different rules under IFRS. So wine is the classic example of a long-term production process. We're not quite done. We have one more. Decommissioning costs incurred as a part of the extraction of minerals. So if you think in terms of an Alberta example, this would be the overburden for oil sand production. So you need to actually take off the overburden of soil and trees and grass and all of that stuff. You have to take it off so you can mine the oil sands below, and then you would have to put it back, and you're actually legally required to put it back. And so one of the expenses of Syncrude's financial statements, one of the costs of their extracted minerals, the oil, the heavy oil that's produced, one of the costs is the cost to put it back. put the overburden back at the end. I always like that term, overburden. It's not really a burden. It's perfectly good stuff, but they just have to put it back. So overburden to get down to your oil set. And that's it for chapter 8, question 4. That's part A anyway. So the next question is, how would any of this change? How would your response to this question change under IFRS? Well, under IFRS, the treatment of borrowing costs differs from ASPE. So interest costs would be considered product costs if the inventory takes a long time to produce or manufacture. But didn't we say that? Where's interest costs? Interest costs, number 11. Number 11, we determined that was the optional one, right? Maybe capitalized if the company elects to do so. If not, under ASPE, they could be just expensed as part of interest expense or financing expense. So part B, the solution says that interest costs are considered product costs if the inventory takes a long time to produce or manufacture under IFRS. Capitalization is not required for interest expenses relating to inventories manufactured in large quantities or produced on a repetitive basis. So number 11 was interest costs incurred for inventories that are routinely manufactured in large quantities. That would fit the definition. So capitalization would not be required. A company can choose to capitalize this as an accounting policy choice. Additionally, under IFRS, decommissioning costs incurred as part of the production process are treated as product costs and inventoriable. But didn't we say those decommissioning costs? So 27 here, 27 is the one I'm referring to. Under ASPE, the decommissioning or restoration costs are added to the cost of the related natural resource asset. And that will come up again in chapter 10 and chapter 13. Part of depletion costs for related natural resources. So the note saying that decommissioning costs incurred as part of the production process are treated as product costs and are inventoriable costs. So I think both of those pretty much said that the rules are fairly similar between ASPE and IFRS. Because the ASPE list included all of those. So why did I put 27 over there? You're probably wondering. Well, yes. That's wrong. 27 is supposed to be over on this part of the list. Okay, good. Let's move on to exercise 8, question number 6. Exercise 8, number 6 is the one that's shown here now. It's a lower of cost and net realizable value question, and we have some wicker chairs, lounge chairs, straight chairs, and armchairs, and we need to figure out what to do with them in terms of allocating the lower of cost and net realizable value. So question number 1 says rounding percentages to 1 decimal place and all other amounts to 2 decimal places. What is the total cost of the chairs remaining in inventory at the end of 2017 using the relative sales value method? The problem here is that we purchased all of them for a lump sum of $59,850. There was a railway car load of them. And we got them because they were discontinuing manufacturing of these wicker chairs, and they wanted to dispose of everything, so we took the deal and we had to sell them. So 3 types of chairs are included in the carload as described here. Lots of straight chairs, fewer lounge chairs, and even fewer armchairs. Armchairs are worth a little less than lounge chairs, and straight chairs are worth a little less than armchairs. So they estimate the cost to sell the inventory would amount to $2 per chair. And during 2017, They sold 350 of the lounge chairs, so they have 50 left. 210 of the armchairs, leaving 90, and 120 of the straight chairs, leaving, what would that be, 580 of them. Then at December 31st, 2017, the remaining chairs were put on sale. The lounge chairs were put on sale at 25% off the regular price, so 25% off $95. The armchairs at 30% off, the straight chairs at 40%, and they were expecting all of them to be able to be sold at those prices. So the relative sales value method says that we just take the estimated selling price and we divide the cost of $59,850 proportionally between the three classifications relative to their sales value. B, what is the net realizable value of the chairs remaining in inventory? There we have to take the estimated selling price and take off the $2 per chair of selling cost to determine what the net realizable value is. And then C, what is the appropriate inventory value to be reported on the December 31st, 2017 statement, assuming lower of cost net realizable value is applied on an individual item basis. So we should include the we're going to analyze each separate type of chair and determine the lower of cost and NRV on that basis. So you ready? Here we go. So let's move it up because there's lots of room in Excel. And here we have E8-6. We have three types of chairs. The first question is, what is the total cost of the chairs remaining in inventory at the end of 2017 using the relative sales value method? So first of all, we have to calculate the relative sales value at the time that we purchased the chairs, because we're allocating the $59,850 between them. So we have lounge, lounge, how do we get it? Lounge right there, straight, and arm chairs. The number is 400, 700, 700, and 300 respectively. The selling price is 95, 55, and 85. And then we extend it. So we just simply go 400 times 95. If we were in class, of course, you'd be calculating these for me. But since you're not, I'll take care of that. And we probably should do our usual transformation using a format similar to accounting. So there we go. There's the extended price. And now we need to allocate it between let's go up here. Let's put those two together. One of the things we can do in Excel is we can actually combine both of those cells, and we'll call it allocation. And here we're going to put percentage, and here we're going to put dollars. Okay, so the total dollars, have to add up to we need an accountant's top and double bottom border. The total dollars need to add up to 59,850. Now if we type in comma, it'll automatically put a comma in for us. Alright, so we need percentages. And so what we're going to do is we're going to take this value and divide by this value, and then we're going to make this value an absolute value with the dollar signs. So 0.63 It says we're supposed to round percentages to 1 decimal place. So let's add 1 more decimal place. Like that. And then we can just drag them down here because we've established the extended column as a relative column and the total 59,850 as an absolute reference. So that's the first part. Then let's just take that one and multiply it by this one down here. And if you're working on Excel, if you hit the F4 key while you have a reference like this open, it will toggle through various absolute references. So this means that the row 30 stays the same if you copy this formula to somewhere else. This means the column stays the same. This is back to a relative reference, and this is an absolute reference. We'll just use the absolute reference here. All right. Somehow we have 3 digits in the result. So let's fix that by taking them out. There we go, 38,000. For these lounge chairs, 38,500 worth of straight chairs and 25,500. That's a different number than our solution says we should have. Okay. Well, how come that? Something's very strange here. Okay, I see what the problem is. I have the wrong total. This total should not be relative to that cell. That should be relative to that cell. So the question we want to ask is, what percentage of the sales value is represented by each of these 3? So there, that makes a little more sense. Now let's check to see that that actually does add up to 59,850. Oh, this is going to be a circular reference, isn't it? Yeah, let's take a moment to think about how that works. Well, rather than wasting a bunch of your time, let's just put in 59,850 as the value, and then we'll click like that. Okay. So, and then let's do the summation sign, because it's no longer a circular reference. 59,850. So that's good. So 22,297, 14,963 and 22,590. Slightly different from the solution manual suggested amounts. They got 22,324, and of course our numbers are not actually rounded to those numbers. Let me try something here. Oops, that's not what I wanted to do. Alright, my mouse is being difficult. There we go. It adds up to 100%. Okay. So our numbers are actually more accurate than the numbers in the solution. So when you take a look at the solution, you'll see that they actually used 37.3% to calculate this number. If you add up the 3 numbers that they used 37.3%, 37.7, and 25. Should be the same thing. Not quite sure how they got their values. Okay, so those are the percentages. Then we apply that percentage by 59,850. Not really sure why there would be a difference, but it's a pretty small difference. The 22,297 is allocated to 22,324. And I'm not sure why theirs would be different. It's a mystery. All right. The total value is 102,000. It's just a mystery. We're not quite done with A though. That's just the first step. So what we've used, this is called the relative sales value, so maybe we'll type that in here. Relative sales value. Okay. There. All right, so that's just an allocation of the cost according to their, the total cost is allocated on the same percentage as the total sales value. But that doesn't answer the question that we're interested in, which is actually what is the value of the remaining inventory. So let's just copy that whole thing down here, and then we went to value of remaining inventory. Okay, well, we do remaining inventory. So here we have a different number. We probably should calculate the unit cost here, because we're going to have to use that below. So let's go unit cost. And here we're going to be taking this value and dividing it by the total number of units. So that number of chairs, 5574 is the number we get, slightly different from the solution. So let's simply take the second column here, and instead of being price, we'll call it unit cost, and just multiply that across, and we can get rid of all of this. Let's just copy a blank cell, and we'll tuck that over here. There, now it all goes away. Okay, so we have checked to make sure that it actually does give us the results back. Now, how many lounge chairs do we have left? Well, we have 400 minus the 350 that we sold. People like lounge chairs. People don't like straight chairs very much because we only sold 120 of them. So 700 minus 120 leaves us with 580 of them. And armchairs, a little more popular. It's 300 minus 210. So 25,994. Again, there's a slight $20 rounding difference from the solution, which I'll post for your consumption. Actually, I probably already have at the time of this publication. Alright, so then the next question is, what is the net realizable value of the chairs remaining in inventory? The issue here is that we have discounted the selling price at the end of the year, so at December 31st, 2017. So all of the chairs are put on sale at a lower price. So the price would be reduced by the relative percentages that are stated, and then it's going to cost us $2 to sell them. So how's the best way to set this up? Okay, so this is the cost. Oh, well, we're using the same number, so let's just use the original sell price, and then we'll have the discount, and then we'll have new price, and then we'll have selling, and then we'll have NRV per unit, and then we'll have NRV of a total. Okay. I'm going to pull this back a little bit because we need a little more, space. So the original prices are just shown up here. So we can grab those and just pop them in. The discount, the lounges are 25% discounted. The armchairs are 30%. The straight chairs are 40%. Seems to make sense because we haven't sold a lot of them. So the new price is going to be that number times 1 minus that percentage. Okay, didn't like that. Oh, we need to do multiplication. It's wondering what it wants us, what we want it to do. So 71.25, 59.50, and 33. Yep, those are the right new prices. Then we're going to take off the selling cost of $2, $2, and $2. And so then the difference between those two, that one minus that one, gives us the net realizable value per unit. And then if we multiply them out, we take this number over here, we multiply by net realizable value per unit, and that tells us what the total net realizable value is. Pop them all in there, and then we'll just copy the summation over to here. Okay, very good. I suppose we should use our accounting format for that, so we get some nice little commas. Alright, so that's looking pretty good. $26,618. $26,617.50. So if we wanted to actually show the $617.50, we need to put 2 decimals back. Okay, why are you not giving me decimals? Please give me decimals. There we go, yeah, 3462.50. And the question does say we're supposed to round to 2 decimal places for these. Alright, so we're not quite done. We have calculated the net realizable value of the chairs remaining in inventory, so that's what these all are. And so that's kind of A and B. Put my little B down here. I'll just take it out of that. So that answers B. B is this over here. It's the total net realizable value. The next thing is, what is the appropriate inventory value to be reported on the December 31st, 2017 statement of financial position, assuming the lower of cost and net realizable value? Well, fortunately we have the unit cost listed here, and we have the net realizable value per unit. I think maybe I want to tuck that in a little bit. Okay, so maybe we'll get a little more room here. There we go. Yeah. All right. So now the next question is lower of cost. Lower of cost and NRV. So we could actually set up a formula for that, or we could just compare the two. So our net realizable value for lounge chairs is $69.25. They cost us $55, so in that case we just keep the cost. So we're going to just put in the cost over here. And for straight chairs, the net realizable value is $31. Cost is $32.27. So that actually means that the net realizable value is lower. So we'll use 17,980. And then the last one, 57.5, is the net realizable value for that category. And 49.88 is what it cost us. Armchairs still keep their cost. So we record them at cost. And then of course we need a sum just like that. we could pop a couple more dollars, a couple more digits in order to fulfill our requirements. So 25,555.88. So again, there's a slight difference between the calculated values in the solution and our calculated values here, but it's not a significant difference. Okay, so that's A, B, and C. On an individual item basis, each of them gets their own category. If we were using, one of the alternative bases is just to do the total inventory. In that case, the total at realizable value is 26,006, and the total cost is 25,994. We wouldn't have to write it down to the lower value in that case. So the only journal entry that would be required here would be to record the straight chairs at 17,980. So we would reduce the value credit straight chair inventory 17,980 minus 18,718. So we reduce it by what, $738. And that is it for question 8-6. Next one we're looking at is 8-12. Let's just scroll down here a bit. Here we're using the gross profit method. And the gross profit method is a way of estimating the cost of inventory when we don't know the cost of inventory exactly. So the questions are fairly straightforward. How much should ending inventory have been? And if the controller's ending inventory amount was due to an error, suggest where the error might have occurred. All right. So let's see how that works. Now the idea here is that we know the amount of sales, and we know the beginning inventory, and we know the purchases, but we're not really sure about this ending inventory number. So the story goes like this. Linsang Corporation's retail store and warehouse closed for an entire weekend while the year-end inventory was counted. When the count was finished, the controller gathered all the count books and information from the clerical staff and completed the ending inventory calculations. Prepared the partial income statement shown below. The general manager called the controller into office after quickly reviewing the preliminary statements and said, "You've made an error in the inventory. My pricing all year has been carefully controlled to provide a gross profit of 35%, and I know the sales are correct." So, the general manager apparently is a better master of the gross profit method than the controller. So let's see whether the controller's number is actually off. So we would expect the cost of goods sold to be the rest of this 35%. So the profit is 35%. The cost of goods sold is the other 65%. So let me just move this out of our way and scroll down a bit. And we'll put in exercise 8-12. Kind of like this. This is better than whiteboard, than writing on whiteboard. So doing Excel calculations, that's a lot easier for you to tell the numbers I'm writing as well. And it saves you having to do all of that work to do the calculations. A number of advantages, but still, I think the process of working through it in class is still worthwhile. So, where are we going to start with this? Well, we start by recognizing that the sales is $27.50, and that the cost of goods sold is the sales amount minus the gross profit. So, our sales is $2,750,000. I'll put a comma in there. There we go. And the gross profit is 35% of the sales. Not 3%, but 35%. So we take that, 2750, and multiply by 0.35. And of course we need a bit of formatting. wrong way. There we go. That's better. Okay, so that means that the cost of goods sold must have been the difference between the two. And of course, that should give us the, well, actually I don't think we don't want the bottom border, so let's go back to no border. We'll just pick up that top border. There we go. Okay. So the next question is, if that is our cost of goods sold, then we can compare that to the goods available for sale. Cost of goods available. Oh boy, didn't have enough room. A couple of things we could do. Let's just cut it out of there and pop it over here. Can't do that on a whiteboard. 2,200,000 was the amount of the cost of goods available for sale. And so now we can use our little double underline, our accounting result. We want to take the cost of goods available and subtract the cost of goods sold. And this is our gross profit method, GP method estimate. Of inventory, ending inventory. All right. So 412,500 is the amount of inventory that we should have, and of course the controller's version said 650,000 was the amount of inventory, and the difference was fairly substantial. So the cost of goods sold was overstated by cost of goods sold should have been 1787,500, and I'm not quite sure why the general manager would complain about that, because it makes the profit look better, but I suppose it's more accurate. Alright, so next question. If the controller's ending inventory amount was due to an error, suggest where the error might have occurred. Well, the ending inventory is overstated, so it might have been for a number of reasons. You're looking for a reason that the physical count, which is essentially what they're describing, right? They've got all the count books, and they take all the information and multiply it by invoices. There could be an invoice pricing or an extension error, which means that the controller could have multiplied by the wrong number. So that's a possibility. Could also be the case that the total amount of purchases, would be wrong. So 1550. It could be that the opening inventory was wrong. That the general manager seems to be on top of things, so there's a good chance that if the opening inventory is wrong, the general manager would have caught it. There could have been losses through theft, or other spoilage, other shrinkage items. It could be that the sales were recorded at the wrong amount, because we're basing the cost of goods sold on the sales and the gross profit percentage. It could be that the gross profit percentage was miscalculated, but the general manager says not. My pricing all year has been carefully controlled to provide a gross profit of 35%, and I know the sales are correct. So the general manager doesn't think so. Now, spoilage in this case isn't really, it's the wrong direction, right? Because the physical amount that we've calculated, 650,000, is higher than the gross profit method estimate of ending inventory. So missing inventory isn't really a problem. So we have too much inventory, and too much inventory means that there's either a pricing error, so we've priced them improperly. Presumably the count could also be an error, so they could have counted more than there actually were there. And it's possible that the gross profit of 35% might not be correct, but the general manager assures us. So reasonable explanations basically say that the count could be wrong because the pricing process or the counting process, it either has to be the physical units, the number of units, or the value that we've attached to them. Now, usually the value would be attached by looking at the vendor invoice. So as you will learn in your audit course eventually, that would be the way you would test to see whether or not the inventory was properly priced. Would be to test the pricing of the inventory back to the most recent invoice or the appropriate invoice for the purchases of that inventory. And so that pricing or extension calculation could have been wrong. Anyway, that's enough for this problem. That's 8-12. We have one more that we're going to do. Question 18. And this is question 18. We are looking at periodic inventory. It says, assuming that the periodic inventory method is used to calculate the inventory cost at May 31st under each of the following cost flow assumptions. So FIFO would be the same whether we use periodic or perpetual, and the weighted average, and weighted average means that we calculate the cost of goods sold at the end of the year based on the average purchase of all of the purchases during the year plus the beginning inventory amount. And that says which method will yield the higher current ratio or gross profit. So we have a bunch of information which I will transcribe. Well, actually, I think we can probably do the calculations. We're just looking for the inventory cost, so we should be able to figure that out fairly easily. So for FIFO, if we add up all of the units in category here, so we've got 100 plus 800 plus 400 plus 300 plus 500. Over the year, we have a total of $2,100 or 2,100 units available for sale. The unit cost is shown here, and so the total cost is $9,240. So for the purpose of the weighted average, we just take the $9,240 divided by the 2,100 units, and that gets us our weighted average, rate, and then we apply that to the remaining inventory. So we need to figure out how much inventory we actually have remaining. Well, we have 2,100 that came in and 1,400 that went out, so that means that our ending inventory is 700 units. Everybody follow my cursor waving here. So 700 units are left, and the unit price is shown here, and the sales value would be the same. So whatever the higher cost of goods sold would be correlated, would be the one with the lower ending inventory number. So we need to figure out what the ending inventory number actually is. FIFO, we have 700 units, so we have to track in FIFO. Now remember, with FIFO, the inventory is the oldest 700 units. No, I'm lying to you. The cost of goods sold is the oldest units. The newest 700 units is the ending inventory. So FIFO, all of the old stuff is already pushed through the pipeline. The stuff that's remaining is the ending inventory. So we just count backwards. 500 here. That entire 500 unit purchase is still in inventory according to the assumptions of FIFO, and then we take 200 at the price of $4.60. So let's do that. Here we have exercise 8-18 and A, and then we'll do FIFO. Oops. Not sure what happened there. And then we'll say purchase 25 May. We had 500 units, and the cost of those units was 4.58. So the extended value is simply that times that. We need a little more clarity here. So we need a couple more digits. There we go, that's better. And then we had another purchase on the 18th of May, which was the second last purchase. We need 200 units for a total of 700. Alright, and let's do our accounting border here. There we go. The cost of those 200 units was 4460. Once again, we have a problem with decimals. Oh, that's too many. Ah! Alright. Well, I guess it's not actually wrong. And then we multiply that out. So 2290 is 500 times 458. 920 is 200 times 460. The total cost, copy that, paste that, $3,210 is our ending inventory at FIFO. For weighted average, we take the cost, so we go cost of goods available, and that would be 9240, and then we divide by units available for sale, and that was 2100. And then we can just put in a bottom border to make it look like we're calculating the fraction. Whoops. Again. Alright, so what does that work out to? Well, we just take that number and divide it by that number. So again, we have dollars on top and units on the bottom. It's $4.40 per unit. And let's make one more digit. And then we use that rate for the 700 units. Ending inventory is 700 units. So the value in dollars is simply the 700 units at $4.40 or $3,080. The cost of goods sold, of course, is going to be the other side of the transaction. So the cost of goods sold would show that the total cost of goods available for sale is $92.40. If we subtracted the ending inventory, that gives us cost of goods sold. So the second question asks us which method will yield the higher gross profit. Well, it says higher current ratio and higher gross profit. Well, the current ratio is based on the inventory value, so the higher current ratio would be FIFO because inventory is 3210 instead of 30,080. So this is the higher current ratio. But this one would be the higher, hold it, it's gross profit, we're not talking about cost of goods sold. This would be the higher cost of goods sold. So if it's a higher cost of goods sold, that means a lower gross profit. So this would be the higher gross profit. And that's that. So FIFO gives us the higher current ratio and the higher gross profit, which makes both of them look better. In some situations, it's usually the case if we've got rising prices. Rising prices would mean that prices are going up over time, and that's the case here because they went from 410 up to 458 by the end of the period. In times of rising prices, FIFO emphasizes the most recent purchases as inventory, so the cost of inventory tends to be fairly high. And if the cost of inventory is fairly high, that means that the cost of goods sold is all of the cheaper earlier purchases. So that means our gross profit would be better. So weighted average in general, weighted average in a time of increasing prices, weighted average would be a lower current ratio and a lower gross profit. So both the balance sheet and the income statement look worse. All right, that's it for the sample problems in Chapter 8. Thanks for listening.